Hi, I'm Bob French. I wanted to take a few minutes to talk about bonds, and specifically what they really are. For most investors, stocks and bonds are pretty much the basic building blocks of their portfolios. You use stocks for growth, and bonds provide the stability. The problem is, most people don't have a very firm grasp on what bonds actually are, or what stocks are for that matter. But it's really important to understand what bonds truly are and what they're doing if you're going to use them to help you reach the retirement that you want. So, what are they? Well, they're loans. If you buy a bond from the issuer, you're making a loan to that organization. So if you go to Treasury Direct and buy a U.S. Treasury bond from the U.S. Treasury, you're making a loan to the U.S. government. You're giving them money, and they're promising to pay you back with interest. Now, notice that I said when you buy directly from the issuer. This is what's called the primary market. But there's also the secondary market. This is where you buy and sell bonds with other market participants. So when I come to you and buy that Treasury bond that you bought through Treasury Direct, that's on the secondary market. And the secondary market is massive. To put it in perspective, the global bond market is roughly twice the size of the global stock market. But let's take a little closer look at the bond itself. There are all sorts of different variations, but with a typical bond, the structure is pretty simple. Again, it's just a loan. There's lots of paperwork and legal documents, but it's pretty straightforward. When you buy a bond, you're effectively buying a stream of cash flows. And crucially, you know exactly what those payments are going to be and when you'll be getting them. And if they don't make those payments, what's called defaulting on the bond, bad things happen. If it's a company that defaults, then the bondholders can force them into bankruptcy and get their hands on whatever is left over through the courts. If it's a government that defaults, the bondholders may not be able to take over the country, but that country will likely have a hard time borrowing more money in the future. But let's assume that the issuer is able to pay off their bond. Let's break down the cash flows. First off, there are two parts to the cash flows, typically. For bog standard bonds, you have the principal, which is the amount of money that the company was actually borrowing when they issued the bond. You'll get that money back at the end of the maturity of the bond, basically the end of the life of the bond. The other term you'll hear is, well, the bond's term. This is how long it is until the bond's maturity. So if you have a bond that matures, when you get your principal back and the bond is done, in 5 years, the bond's term is 5 years. The other part of the cash flow are the coupon payments. These are the payments that you periodically, usually semi-annually, get over the life of the bond. These payments are the interest portion of the bond's cash flow stream. Again, it's a loan. So if you have a $100,000 bond that pays 5% interest per year and matures in 5 more years, assuming it pays interest semi-annually, you would get 10 payments of $2,500 since the 5% annual interest is split into 2 payments per year. And at the end of the 5 years, you would get the principal payment of $100,000. But remember what I said about the primary and secondary market. On the secondary market, when you're buying a bond from another investor, there's another number that comes into play. The bond's price. When you buy from the issuing organization, you're almost always buying at what's called the face or par value of the bond, the amount that you'll be getting back as principal when the bond matures. And they convince you to buy the bond, to loan them that money, by offering a high enough interest rate to make it worth your while. Well, in most cases, those interest payments are set for the life of the bond. Again, with bonds, assuming they don't default, you know the cash flows that you're going to be getting. Though we'll talk about a couple exceptions in a minute. But the rest of the market doesn't sit still. That coupon payment may have gotten you the face value when the bond was issued, but pretty much immediately, the market moved. If interest rates started tracking up, then investors won't really want to pay as much for the bond. They can go out and buy a new bond that has a higher interest rate. So the price of the bond will go down, so that it's trading at a discount. Its price is lower than its face value. On the other hand, you may have a situation where interest rates drop. In that case, it's going to go, the other way. Investors will be willing to pay more for those coupon payments, since new bonds will have lower interest rates. The bond will start trading at a premium. Its price will be higher than its face value. Up until now, we've been talking about typical bonds, but in reality, there are all sorts of different bonds out there. Though there's a reason that the typical bond that we've been talking about is so typical. But there are two other types of bonds that I want to briefly mention because they can be really useful for planning purposes. The first are Treasury Inflation Protected Securities, or TIPS. As you might guess from the name, these are bonds that are issued by the U.S. Treasury that have inflation protection built in. They have interest payments just like regular bonds, but they actually adjust the bond's principal amount through time based on the U.S. inflation rate. This is really useful because it's a simple way to hedge your inflation risk, and retirees tend to be particularly exposed to inflation. On the other hand, these principal adjustments can have some pretty nasty tax consequences. So you want to be careful about how you use TIPS. The other type of bonds that I want to mention are municipal or muni bonds. They're called municipal, but really they're bonds issued by a government organization below the federal level. So towns, cities, counties, etc. all issue muni bonds. These usually look like typical bonds. You give them money and they promise to pay you specific amounts of money at specific times. But what's interesting about them is their tax treatment. Depending on the specifics of your situation and the bond you're buying, the money kicked out by the bond may be entirely tax-free. Though, as you can probably guess, this is one of those areas that gets pretty complicated pretty quickly. But depending on your situation, they can be a really useful tool from a planning perspective. So now the big question. How do you use bonds in your retirement income plan? Well, basically, they're the safe part of your investments. Sailboat metaphors are really cliche for financial stuff, but unfortunately, this one works really well. If you think about your portfolio as a sailboat, your stocks are your sails. They push your portfolio forward, but they'll also push you wherever the winds happen to be blowing. But bonds are there to be your keel. They're going to slow you down a bit. Bonds have a lower expected return than stocks since they're less risky. But they'll help you keep moving in the general direction that you want to be going. You can also use bonds to create a bond ladder to lock in a certain income level. Again, assuming the bonds you're using don't default, or just to immunize specific future liabilities. One of the really common approaches using bonds this way is to set up a ladder that will help you bridge the gap between when you retire and when you start collecting your Social Security benefits. Bonds are great tools, but just like anything else, you need to understand them to get the best use out of them. If this was helpful, be sure to like this video and subscribe to our channel so you can see what we're up to. If you have any questions on this, or if there are any other questions that you'd like me to address, just drop them in the comments below. You can also check us out on the web at retirementresearcher.com and make sure to sign up for our weekly newsletter to keep up to date with everything that we're doing.